so I don't want to belabor this too much. I just want to pass this over to the guru, my brother, Gerald Ali. Peace. Unmute yourself, bro.
I did. Okay, okay. Well, again, I want to thank Shanice and Joseph for the great introduction. And, he's right. We've had many conversations in the past regarding insurance and estate planning and talking that type of talk with him and some of the family. And I just want to say that I'm very, very thankful to have been allowed to get into the insurance business. And there's a few people I want to thank before I even get started. First of all, I want to thank God, because without God, I never would have got started in the insurance business. I never would have had life to go to do anything. And so that's that number one thank, is that God has directed my life through all the different things I've done in my life. He's been there for me, directing me and showing me the way. Secondly, I want to thank my parents. I have phenomenal parents who've been there for me and directing my life from a spiritual level, as well as business, as well as friendship. We've had a great relationship over the years, and they've been my number one mentors from the beginning. Then I have my wife, who stood by me now for 37 years, and she's been with me since college days, so she's been there as a rock. Then I have my children. I have my son, Michael, in New Jersey, and I have my children all over the United States who've been there supporting me in this effort, because truly it is a labor of love. You cannot do this business unless you're truly focused into what it's really all about. I had a chance to get involved in the insurance business back in 1982. I started out in Long Island and had great mentors in Long Island with a company called The Guardian Life out of New York. My first agency I got involved with was Harvey Greenberg and Associates in Long Island, and I was able to work with them for the first 5 or 6 years of the business. After 6 years, I realized I didn't want to live in Long Island, so I expanded down to Virginia and expanded into Richmond, Virginia, and set up an office in Virginia, and have been working back and forth ever since. So over the course of my first 6 or 7 years in the business in Long Island, I was exposed to Wall Street, had a chance to work with stockbrokers, investment bankers, lawyers, doctors, etc., to get a very, very good understanding of the business and how life insurance is truly the cornerstone for all financial planning. Now, as an African American, growing up as a young person, I didn't hear much about life insurance. I didn't hear much about investments in the stock market. Just didn't have that narrative spoken about in my home. However, my parents were business owners in addition to working, and so we had a privately owned business while I was growing up that gave me a chance to have a working relationship with business concepts. I then used some of those concepts of high quality service, discipline, and giving more than what you paid for as an effort to become successful. So now that I'm in the business, this is my 38th year, I'm now doing business in about 12 states, pretty much the whole East Coast plus California. In the process of doing the business over the last 38 years, I've had approximately 10,000 appointments with clients, individual clients, 10,000. As a result of that, I'm servicing about 700 clients on an active basis. So when I sit down with someone and talk about what I know what I know from the process of doing it. That's what it's really all about. So today, I'm going to give a presentation primarily in a conversational tone, because this particular presentation is going to be very personable to me. And the reason why it's very personable is because we had loss of family members about 3 or 4 months ago. I think it was March. I'm sorry, it was the end of December the 16th. It just so happened that I lost my sister. And we had just been together at Thanksgiving, and we had went to Alabama and spent time together, and we really had a great relationship. We were down there. She comes back to New York, and she's back about a week, and within a week time, she had some complications, and she passed away. So that was a shock to my system, and it was a real wake-up call about the value of life and how people in your life can be here today and gone tomorrow. So the first thing we're going to talk about in terms of life insurance is that you never know when somebody is going to leave here. And so that was a big shock when my sister passed away and having to go through all of that. Then about a month and a half, 2 months later, my dad passed away, who had already been sick with diabetes and dealing with all of the things that come along with diabetes. And eventually he got sick, had to go into the hospital, and they found out he was affected by the coronavirus. So I think it was on March 31st, I think he passed away. And that was another shock to the system. And when it hits you at home, when it's your own family, it's a different situation than when it's a client. Because when it's a client, you're observing it and you're seeing what's going on. But when it happens to your own family, you are a part of what's going on. And as a result of those relationships with my parents and my siblings, I've always talked about the value of having insurance. My sister, when she passed away, even though she was divorced at that time and a single woman, we had had conversations about the fact that if she passed away, we wanted to make sure that things she was doing with her parents and things she was doing with her church were continued. Again, life insurance stepped in and allowed those situations to continue. Things that she did for my parents, things that she did for the church are now being able to be continued because she had life insurance in place, which allowed transition of capital to create things and keep things going. My dad, when he passed away, we also had insurance in place to make sure that the things that he had in place for the family would be able to be continued, and that my mother, who was now going to be there by herself, had the financial wherewithal to be able to pull back and be able to actually grieve without financial worries. Nobody understands what it's like to have peace of mind in a very, very tough emotional time, and to know that you can just stop for a minute and be able to exhale and be able to deal with the loss of a family member on a very, very personal level. So many times in today's world, I'm hearing about people who are talking about setting up a GoFundMe page because they don't have the resources to pay for a funeral. They don't have the ability to take care of loved ones. And as I start to grow and understand the business, what I realize is that life insurance in its purest form, is a statement of love. When you buy a life insurance policy, what you're really doing is you're actually writing your family the best love letter that you ever could. Because if you love somebody, you want to take care of them. You want to make sure they have clothing. You want to make sure that they can eat. You want to make sure they have opportunity to advance themselves, whether it's educationally or whether it's being able to go into their own business. You want to be able to create options. So a life insurance policy is actually an act of love because it transfers the love that you had when you were alive, whereas after you pass away, it's continued. So that's one of the important aspects of life insurance. Now, we're going to go into this PowerPoint presentation, and I'm going to walk you through some slides that I think are very important. To reiterate my background, again, 38 years of life insurance and an advising experience. I was also a licensed investment advisor with my securities license for about 28 years. Currently licensed in Virginia, New Jersey, Maryland, DC, Florida, Colorado, Texas, Massachusetts, North Carolina, California, servicing probably over 700 clients. In my primary company, which is the Midland National Life out of Sioux Falls, South Dakota, I'm ranked in the top 1% of all life insurance agents in the company. And I say that not to be braggish, but just to say I'm very, very serious about what I do. I understand that the decisions I hope my clients make are decisions that are also on a generational level. They impact not just the current situation, but also impact the future. The importance of life insurance as a cornerstone of your estate plan. Now, most people, when they think about an estate plan, they think about people we see on television with the large estate, the big house, the big grounds and all of that. In its simplest form, the estate plan really is just organizing the things that you own in order to have a transfer of your assets to your heirs in the proper method, okay? Now, one of the things specifically about life insurance is that when you take out a life insurance policy, you create an immediate estate. when somebody takes out life insurance policy, let's say it's a $500,000 policy, and that policy goes into effect, you have created an immediate estate, because now if you die, you've created an asset that can be passed to your beneficiaries tax-free. Now, not many assets give you the leverage that life insurance does. Persons, let's say 43 years old, a male 43 years old in good health, making, let's say, $50,000 a year, that person could buy a policy for at least 10 times what they make. So 10 times 50, of course, is 500,000. So a $500,000 life insurance policy can be taken out with the payment of 1 month's premium that could be $100 for a term policy. What that means is that if that person is approved for that policy and they should die one day after the policy goes into effect, that family has now created an estate of $500,000 that's transferred to the beneficiaries tax-free. Now, understanding that in years gone by, in the old days, people thought that the life insurance was designed for burial, that you take out life insurance to pay for the funeral of somebody who's deceased. That's a very, very small part of what life insurance is intended to do. Life insurance in its truest form is created to replace income that an individual was making, so that if he's not there or she's not there to create wealth, the money that that person would have earned over their lifetime is captured in a life insurance policy and transferred to the heirs so that they can still have the income that that individual was producing. That is a very, very important part of what it's really all about. Now, there's a couple things that impact life insurance. Number one is you have to be in reasonable health in order to obtain and qualify life insurance. So insurance companies do underwriting on a policy that basically means they're going to look at your health, they're going to look at your financial condition to see if you are a good risk to qualify for a life insurance policy. So that's why having good health, making sure that if you have any health conditions like high blood pressure, you have problems with the kidneys, you have whatever it is, that you go and get the medical treatment, because it's not that you can't qualify if you have these conditions, but they want to see if you're controlling the conditions that you have, so that therefore you're not as high a risk when you have the condition, okay? In addition, life insurance is age specific. That means that the younger you are, the lower the premiums are, because the younger you are, that means that the insurance company has a longer time to invest those dollars, and that's tied to what's called mortality tables. And mortality tables is how they figure out of 100 people, how many people will die at a certain time, so they can then set aside funds to be able to pay those claims, okay? So the younger you are, when you understand the need for life insurance, the more you should buy, because you're getting a better rate on the policy, okay? Now, in today's times, when I started the business back in 1982, we used the 1958 tables called the standard and ordinary tables, and that was based on the life expectancy of people in 1958. So their life expectancy would mean that they would live to, let's say, age 65, 66, 67, and then it was predetermined that they'd pass away at that point. But then in 2001, 2002, they had to redo the tables, and now we have the new specific tables for mortality that say somebody should now live to age 75 or even 80. So what's happened? Insurance cost has come down significantly for life insurance, because people are living for a longer period of time because of medications, as well as improvement in health, exercise, etc. So as a result, this is one of the best times in history to buy more life insurance based on the ability to have longer life expectancy. Very, very important. And in the Black community, as we know, the health situation has always been a challenge, because people have not been given specific coverage with health insurance, have not had the same kind of opportunity to be able to have access to the things that will keep you healthy on a longer basis. So we have to try to control that as much as possible. Okay. The types of life insurance plans. Basically, to simplify life insurance, there's basically two types of policies that a person can buy. The first type is called term life insurance, and it's categorized as specific time of 10 to 30-year duration. Term means a specific period of time, which means it can be insurance coverage that covers you for 10 years, 20 years, or 30 years. Those are typical time periods. But when the time period is up on a term policy, then all protection stops at that time. Now, because term insurance is a temporary solution to a permanent problem, many times people will start out with a term policy when they're very young, hoping that their income will go up as time goes on, and then they can convert the term policy to a permanent insurance policy that now can be kept in force for the rest of their lives. So a term policy specifically is for a specific period of time. The shorter the time period, the cheaper the premium. The longer the time period, the more expensive the premium. One of the benefits of term insurance also is the fact that for the, let's say, the first 10 to 15 years of a term policy, you can convert to a permanent policy without having to show evidence of insurability. So therefore, you don't have to go out and get another exam. Let's say you have a $500,000 term policy and you're age 30 years old, and it's a 30-year policy. When you get to age 50, you want to convert to $250,000 of permanent insurance. You still will convert at the attained age, but you will not have to go through an examination to qualify. So you're doing what's called protecting your insurability, okay? I also liken term to renting insurance. When you buy a term policy, you're renting it for a specific period of time. But at the end of that term period, and you know that term policy expires, you now have to go out and buy new coverage and re-qualify all over again and get underwritten again based on an older age. And so a lot of people will buy the cheaper term policy, but then later on in life, they may find that the policy expires and now they have no coverage and they can't qualify because of health conditions. Now, permanent life insurance is life insurance coverage with fixed premiums and can accumulate cash value. It builds up a savings, has the ability to borrow cash value and use as a retirement plan. When I first moved to Virginia from New York, I had purchased several different types of policies, one of which was a permanent insurance. And since I was in New York for 6 years, I was able to build up savings in that policy. So when I moved to Virginia, nobody asked me to move. I decided to do it on my own. So I had to finance the move myself. So I was able to pull cash out of my permanent insurance policy and use that as a down payment on my property. That when I got to Virginia, it gave me the ability to have flexibility and have options. Many of my clients have used permanent insurance as a way to save money for retirement if they're self-employed, a way to save money for education, for college planning for their children. There are many different uses of permanent insurance when it comes to cash accumulation, okay? Now, let's go further. There's basically 4 types of permanent insurance. Number 1 is whole life insurance. And whole life insurance is a permanent type of insurance where the insurance company pays dividends on the policy from the profits that they make in the business. The dividends are paid out once a year and typically average around 4 to 5%. They build up cash value and the whole life insurance policy stays in place for the entire life that the person is living, okay? So it's a permanent form of insurance. Universal life is also a permanent life insurance, but it's based typically on interest rates. And the interest rates are sometimes short-term in nature, or they could use long-term bonds, but these interest rates on universal life will typically return about maybe 3 to 4% as a cash buildup, but it can also create a permanent type of insurance. The next one is called index life. Index life is a policy of permanent nature, but what it does is it mirrors the S&P 500 or other indexes, and it reflects in the cash value what these policies can do in terms of building up cash. So an index policy, when the market goes up, it goes up. But when it goes down, it doesn't go down. It locks the values in. So that's one of the new type policies that's been around, let's say maybe the last 7 to 8 years, which can be very, very beneficial as far as market conditions. It gives you the ability to have upside potential without losses, okay? One of the other types of policies is called a variable life. And the variable life is an insurance policy that has what's called sub-accounts. And those sub-accounts are like mutual funds that are inside of an insurance. So it gives you the ability to do well when the market's doing good, but it can also be very, very detrimental when the market's not good. So depending on a person's personality, their financial situation, that's where an agent should be able to help to direct someone into the type of policy that is most beneficial for their situation. Now, one of the new aspects of all insurance that's been in the last maybe 4 to 5 years, including the term policies, is that life insurance now also has a long-term care rider, or a rider that will help to offset if someone has to go into a nursing home. Let's say a person has a policy of, let's say, to make it simple, $100,000, right? That person could use, let's say, 24% of the death benefit of the life insurance towards long-term care. So on a $100,000 policy, 24% would be $24,000. So if they go into a nursing home, that's a couple $1,000s a month. So every month after, let's say, a 90-day waiting period, they're able to start spending down the life insurance as a living benefit. And that's because now people who would have died, let's say 20 years ago, of a particular ailment are now living longer because the life insurance has a living benefit that allows them to pay expenses down. Why is that important? It's important because if you have assets and you don't have long-term care, you have to spend your own money to cover these assets and pay the cost yourself. So by having a long-term care rider on your life insurance, you're able to spend down money from your life insurance as a living benefit. This is so, so critical in today's times. And this is attached to a term life policy as well as attached to permanent types of policies. And this is the new talk that we're having to all of our clients, because anybody who tells me they already have life insurance, I say, yeah, I understand that, but does your life insurance have a long-term care rider built into it to offset the cost of your situation? Okay, so again, whole life, again, is permanent insurance, has dividends. Universal life is typically short-term interest rates. Index life mirrors the S&P and other investment indexes, but your money is never in the index. It just mirrors it and reflects it in return, okay? Very beneficial. And of course, the variable type policy is where you're actually invested in sub-accounts which are tied directly to the stock market, which can go up and down depending on how the indexes are performing at that time, okay? Now, the next thing we're going to talk about is that there's benefits of non-qualified retirement plans versus qualified retirement plans. What that simply means is that when somebody has a 401k plan on their job, when you make contributions into your 401k, that's pre-tax money. So that type of investment is called a qualified account, which means it's tax deductible to you when you're putting money in. So let's say somebody's making $50,000 a year and they're putting money into their 401k. So instead of paying taxes on $50,000 a year, let's say they put $8,000 into their 401k. They're now paying taxes on $42,000. So they're reducing their taxable exposure, and at the same time, the money is going into an investment that grows tax deferred at the same time. So as a person is accumulating money for retirement over time, the 401k is growing tax deferred, okay? And at the same time, it's growing tax deferred, but it's also tax deductible. Now, until the person reaches age 59 and a half, if you take money out of your 401k, you're going to pay taxes on your money, as well as you're going to pay a 10% penalty because you took it out before 59 and a half. So if somebody, let's say for instance, is terminated from a job and they're not going to work for that company anymore, and they have money in a 401k, if they want to, they can then roll that money over from a tax qualified 401k into a tax qualified IRA, because an IRA is an individual retirement account that you can roll money from a 401k into an IRA and be able to protect the investment in your 401k. Some people make the mistake when they leave a company, they cash in the 401k. And so if you got $40,000 in your 401k and you cash it in, you're going to pay taxes on the full $40,000 plus pay a 10% penalty on top of that. So that's a major, major error. Okay. Now, one of the things about qualified accounts with a job is that if the company is doing a match of 5% and they offer you to match what you're putting in at 5%, you should always do that, because you're getting their money. So you already got a 50% gain on your investment because they're matching what you put in. So that's something you should be doing from day one with any opportunity, is take advantage of the match in a qualified plan. Now, once you get past 59 and a half, you can then take money out of your 401k and you're going to pay taxes on it, but you're not going to have a penalty. Now, under the new tax legislation, it can grow. It was up until age 70 and a half, which means at that point, you have to start taking distributions from either your IRA or your 401k plan. And that's called an RMD, which means required minimum distribution. That means that money has to come out. Let's say let's say you have $100,000 in your 401k and the distribution amount is 4%. So that means you got to take out $4,000 at age 72 now. If you don't take the money out, they will hit you with a 50% penalty on the amount you were supposed to pull out. So it's very important to understand that, okay? So again, 401k plans are qualified plans, pension plans are qualified plans, 457 plans are qualified plans. These are all tax qualified plans that allow you to deduct what you're putting in, and you're putting it in a tax advantage manner. It's growing tax deferred, and when you pull it out, you have to pay full taxes on it, okay? Now, let's talk about non-qualified accounts. Non-qualified accounts would be something like a life insurance policy, where if you take the money you receive from your paycheck and you bring home your after-tax dollars, you've already paid tax on the money, you use that to then fund a life insurance policy by paying the premiums. So let's say you're putting into an insurance policy, you're putting in $2,000 a year, which is roughly $166, $67 a month, okay? That's a monthly premium. So if you did that for 10 years, you put in $20,000. If you did it for 40 years, you put in $40,000 of your own money you put into a policy, okay? So you put $40,000 into your insurance policy, over 20 years, $2,000 a year. So you started at age 40, now you're age 60, right? That $40,000 is deemed what's called basis, B-A-S-I-S. Basis is money that was already taxed. You already taxed it. So let's say your cash value now is $100,000. So when you reach age 60, you say, I'm going to start pulling money out. The first $40,000 you take out of your policy is automatically tax-free because you're recovering your basis or money that was already taxed, okay? Now, the other $60,000, which would be deemed your profit, if you were to cash your insurance in, that money will be taxed as a capital gain because you made a profit on your investment. So instead of doing that and having to pay taxes, we're able to borrow the money out of the life insurance. And in some cases, it can be borrowed at less than 1%, okay? So let's say you got $60,000 in there and you borrow out over the next 20 years, the $60,000 on a loan basis. And so because it's a loan, you don't pay the money back while you're living. The loan comes from the death benefit of the life insurance, okay? So let's say your policy was a $250,000 policy and you got $60,000 in capital gain. That life insurance is now going to pay off the loan because when you die, the insurance company gives your family the balance of 250,000 minus the 50,000 you already spent tax-free, and now they get 200,000. Okay, but the bottom line is this is a way to tax shelter money and create a way to create another vehicle to add income to your situation in retirement, because your 401k is going to be taxed, your pension is going to be taxed, your Social Security is going to be taxed. So all of those financial vehicles, you're already being taxed. So wouldn't it be nice to have a vehicle that you could structure where you have tax benefits that are proportional and give you a better chance to hold on to more of what your investments are? So when I sit down with a client, I look at both types of investments, qualified and non-qualified, and I educate them on how both of these can be used, but you have to know how to use both of them in the right timing to be able to work these into your estate planning, okay? So this is a very, very important part of what I do, because people today are nowhere nearly prepared for retirement, because if you're making, say, $60,000 a year and you retire, after taxes, you're at about, say, 48. 48 is like $4,000 a month. So when you retire and you say, I'm gonna stop working, you still have needs to be met at $4,000 a month. So where is the money gonna come from that you're no longer producing to maintain your lifestyle? It comes from planning and putting assets that can go to work for you to replace the person at work with money at work. And that's what we're talking about, is how to put money at work. Now, the next thing we're going to talk about is legacy planning and using wills and trusts to be able to create a mandate of how money is going to be transferred if something happens, as well as your assets. Now, I want to say in this area, I am not an attorney, and I'm not trying to be an attorney. However, I work with law firms and I work with attorneys, and I've done so for over 25 years. I have attorneys I work with who actually write wills and living trusts. But I bring my clients to these attorneys to make sure that these things get done. For instance, avoiding probate. Why would you want to avoid probate? Probate basically is retitling of assets. When somebody dies, they own property, they own real estate, they own different types of investments, etc. And when they pass away, if they're not the type of investors where it's a beneficiary, like a life insurance, automatically avoids probate. Annuities automatically avoid probate. But other assets like real estate and businesses, etc., they may go through the probate process, which means now they got to go through the courts. And the courts have to define who owns it, how is it being owned, how is it being transferred, etc., which means it creates costs, it creates time. You may hear people saying something was tied up in probate because it has to go through legislative process in the courts. Now, contrarily, when you set up a living trust allows you to put assets into trust ahead of time. So all the things that need to be done are done and preempted. So if you own a piece of real estate, you own a business, you own other types of investments, if you put them inside of a trust up front, you've already avoided the probate process because you've done it on the front end versus having to get tied up on the back end. So I have many.
Pardon, Jerry.
Say it again?
Yeah, I don't want you to get too far away from, somebody has a question.
Okay.
iPhone, whose iPhone? That's Mark, okay. He asked the question, do you recommend companies like Legal Shield in setting up wills and trusts, etc.?
Okay, good question. It depends. It depends on how complex a person's situation may be, because, you know, basically those types of companies, they have what's called a boilerplate situation, where this basically give you all the basics that need to be done. So in some cases, if it's a very simplified situation, it might be something that could work for that individual to use, that certainly using them is better than not having anything. But I would say this, in my experience, having an actual attorney who understands your situation and also understands all the aspects of law, in my opinion, is a better investment of your time and money, because this individual has the experience for many, many years and you can build a relationship with them, okay? But if a person can't do anything else, going to Legal Shield or one of those companies is at least a way to take action and to do something, okay? And I think that in any scenario, having something set up is better than not doing anything, all right? So it just depends on the person's situation, how they feel about it. If they want to do a boilerplate situation and just have it something that's very simplified, that might be one way to go. But the clients I work with, the people I work with, I found that the attorneys have invaluable information who are specialists in that area, which is the estate planning process. Now, getting back to the will and trust situation, again, number one is using wills when necessary in living trust, because you also have what's called a medical directive, which is all part of that. And the medical directive basically says, if you die and they say, okay, well, you're brain dead or all your mental capacities are gone, do you want to be kept on life support system or not? If you say, well, hey, if I'm brain dead, I don't want my family continuing to have expenses and everything else for an exorbitant period of time. If it's like, say, 90 days and I'm brain dead, then let me go, okay? And what that does is it takes the responsibility off of the family, because they're going to abide by your wishes. Whereas if a person doesn't have a medical directive, the family's now got to figure out who says if you're going to live, who says you should stay, they should pull the plug, but you've already predetermined that because you want to take that onus off the family. You want the people to know these were your wishes. I had a client, a very wealthy client in Virginia, whose mother was sick, and when she went into a coma, she was in a coma for almost a year and irresponsive, and it was costing the family something like $8,000 a month, okay, to maintain this comatose state. And finally they realized they were draining all the assets from the family, which you wouldn't have wanted to have happen. So eventually they came to the consensus that they would stop it, and they did, and they were able to save the family's business and everything else because of that, okay? Now, the other thing that they're going to talk about is powers of attorney, which again, powers of attorney is that if somebody is not in a mental capacity to be able to make decisions themselves, then somebody else can step in, typically the spouse or an adult child of this individual, to make financial decisions that need to be made that the person is not in a cognitive state to be able to do. So having powers of attorney on both the husband and a wife is a very, very important part of the living trust, the will, etc. All that is tied into that, but this is just an overview of things that should be considered in this process. Because I'm gonna tell you something. My experience has been when people die what's called intestate, which means they don't have a will, they don't have a trust, nothing. You have families breaking up over these situations. You have people, not speaking to people in their family because, mom said she was supposed to get the car, daddy said he was getting the building, all kinds of mishaps happen. And let me tell you something, when people die, people change. People that you thought you knew and you knew what they were all about, when somebody dies and there's money involved and emotion and property and all these things, all that stuff comes out many times, especially if there's no plan in place to make the transfer equitable, okay? So that's why, I spend a lot of time with my clients, not just talking about insurance and everything else, but talking about what is the legacy you're trying to create from all this. If somebody was to get an insurance policy for $500,000, and then the spouse, either the male or the female, receives $500,000, how much time has this person spent managing $500,000 before? If they've never had experience managing that kind of money, how are they going to be able to direct it tax-wise? How are they going to make sure it's in the right place at the right time, to make that legacy continue, you see? So that's why having sound advice is very, very important. So I have attorneys that I work with who I direct people to. I have accountants that I deal with, I direct people to. I have people who do credit restoration, I direct people to them. People have specific problems. And so what I try to do is to direct them to people that I think have the experience and can deliver services that will allow them to be able to move their position forward, okay? So when you think about life insurance and you think about financial planning, one thing about life insurance, unlike any other investments, is that you gotta be healthy to get it, okay? And I wanna repeat that. See, people can go out and buy real estate. You could be dying and you can buy real estate. You could buy stocks and bonds and you can buy all that stuff. Doesn't really matter what your health is, other than you have to be sound of mind, okay? But if those things are in place, you can buy stuff anytime you want. But life insurance, because of the fact that it's highly leveraged, it's a very, very highly leveraged product, because a person for $100, I give them a policy for $500,000. Okay, if they die the next day, okay, that's a tremendous amount of financial leverage. Okay, so as a result, buying insurance when you're healthy and getting something that you can lock in place is a very, very important part of creating financial stability for the family, so that whatever intentions you have for your children, when they're getting ready to go to college, if you're not there to provide that quote unquote love letter that you sent them, gives them what's called options. Options is the ability to decide, maybe when you come out of college, you don't want to go work for somebody. You want to go and start your own business. Why? Because your dad left an insurance policy payable to a trust that says if you use this money in a specific way, you could use this money to start your own company. You could use this money to buy somebody else's company, okay, an existing business, all right? All of these things can be geared around financial options by using life insurance and using the proper planning process to put your life insurance into effect and to also direct it to be beneficial for families, okay? Now,
hold on, Jerry, before we move on to the next PowerPoint, do anybody have any questions? Do anybody want to share any of their stories?
Well, pose that last question. Pose it as a question, because they didn't pose it as a question, but it's up there to ask the question.
Hi, my name is
Go
Melissa.
ahead. I see somebody muted.
Yeah, this is Melissa speaking. So
If you're talking, we can't hear you.
Can you hear me?
I can
Do
hear.
anyone have anything
Okay.
in the chat that they want us to repeat? Any questions
Yeah,
in the chat?
when you set up the living
Well,
trust,
currently in the chat, Jerry, it says, when you were talking about the wills and trusts, etc., it says, what I think they're asking is, do living trusts completely avoid the probate process once they're set up?
Typically, yes. Typically, they
We
do.
can't hear you. Got to unmute yourself, Jerry.
No, he's not muted. It's us. Go ahead.
So,
Can you hear me?
Yes.
Okay, typically, when a person puts an asset inside of a living trust, that asset, the ownership of it, has been transferred over to the living trust. So they don't have the asset anymore in their own name. So as a result of that, the trust then dictates how that property is being passed on, because it's no longer in the person's name. They don't have control of it anymore, as far as they don't have the property or whatever it is no longer in their name. It's in the name of the trust. So once that's completed, it's a legal transfer. It's there. It's out of the ability to go through probate at that point.
okay, so one more question that I have is, as you stated, you have to be in better health if you want to get an insurance policy. Is there any type of provision for somebody whose health may not be that great, but they would like to have some type of coverage?
Okay, good question. Well, basically, first of all, if the person is not in the best of health in the beginning, insurance companies will offer a policy with a rating on the policy. So they'll say, okay, well, they have rating tables from A all the way to, I think, J. And starting out as A means the person has a minimal health impact. B, a little bit more serious, C, D, E, F, G. It goes all the way out. And as you go out further, they charge a higher premium because they're taking a higher risk, okay? So they would make a determination when a person puts in an application whether the severity of what they're dealing with is a full decline. If it's a full decline, then that means that they may be, in fact, uninsurable from the standpoint of normal health situations, okay? So if a person is declined because of that, like for instance, if they have a type of cancer, okay? If they have, certain types of kidney disease, different things that are very, very serious, they might say that a person is uninsurable, okay? Now, if that happens, one of the alternatives is there are some companies that do what's called a guaranteed issue. And a guaranteed issue policy says, first of all, they're only going to give you a minimal face amount of maybe say $10,000, $20,000 of coverage. But if you take out the policy and you die in the first 2 years of having the policy, they only refund the premiums back that you paid in for those periods of time, plus some interest on your money. But if you live 3 years out, then the full policy is payable, whether it's an accidental death or it's a natural death, but it's like a 2 year to 3 year wait before that policy actually kicks in. But I have used it from times where somebody had cancer, or they had, back in the day, if someone had AIDS, and they had a chance to get a policy, it was the only way to put something in place to protect the family, so at least there will be burial money if they lived at least 3 years, okay?
Okay.
For instance,
Thank you.
yeah, okay? Any other questions, Joe? Anybody have anything else there on their minds?
I don't see anything else in the chat.
Melissa, did you have a question?
No, that's it for now.
Okay, thank you.
Okay, all right. So, in essence, I think that, this is the very important start of an awakening of the fact that, as African Americans, especially, we have a very, very strong financial situation from the standpoint that African Americans in the United States generate more money than the country of Canada. I want to repeat that. We generate more money in terms of what we generate than the entire country of Canada. The question is what do we do with the money that we create? Where does it go? What kind of investments do we put money into? Are we putting money into things that are short-term in nature? Cars, clothes, partying, consuming alcoholic beverages or tobacco or whatever, things that give people immediate gratification? Or are we starting to understand the power of wealth building, which is putting money into things like insurance, like investments, like real estate, like owning your own business, those kind of things which are more permanent in nature, okay? So I'm hoping that, this discussion certainly is not gonna cover every aspect of life insurance and every aspect of, retirement plans, but it's designed to give a broad stroke of information that can be beneficial down the road. So again, my contact information will be on the next slide. And if there's any further questions, they can email me with my contact information. And I want to thank you all for the time that we've been able to share. Hopefully it'll be beneficial to those that, have been able to hear it, and we'll be able to go from there. I want to thank you very much.
So I have a question. So commercial insurance, are you hooked up with commercial insurance?
Okay, I don't personally deal with commercial insurance, but I have people that I'm connected to who do have commercial insurance. And I know people in New York, I know people down here in Virginia, I have connections with people. So if somebody asks me for something, I have a network of people that I can call to be able to discuss that aspect, commercial insurance and property insurance and that side of the business. I know people who do that. Like I can plug people into it. Mm-hmm.
Thank you.
Mm-hmm.
Okay, I have a question as well. I recently came across a video that's on Instagram, and it was about a black male who was being interviewed, and he said that the reason why a lot of black lives don't matter is because a lot of black lives are not insured. He basically was making a statement that if more of us were insured, there would be more people advocating for black lives, because the insurance companies would not want to be paying out these high premiums for people that are getting killed, they would be out there on the picket lines probably before us. What's your take on that type of ideology?
Well, I think that, first of all, in terms of the value of all human beings, okay, is inherent in the fact that we all have potential for growth and we have potential for development. So African Americans in this country, we need to be embracing all the possibilities of how we invest our money, because right now on Wall Street, African Americans control 1/2 of 1% of all the money that's being traded. So as a result, that's why the respect level financially could be improved substantially. Understand what I'm saying? 1/2 of 1% of all the money being traded on Wall Street is controlled by African Americans. Think about what that means. Okay? So that's why, from a estate planning standpoint, wealth being transferred through insurance and that type of thing gives people financial options to be able to create financial wherewithal to be able to impact the market and then impact insurance companies and other financial companies that look at the African Americans not just as consumers, okay, not just as consumers, but as wealth builders. That's important to make that shift. You see, because it changes the perception of people in the marketplace.
Okay, so another final question was, it was posed about jobs that have insurance plans as far as life insurance. Like my current place of employment, they have an insurance plan set up for me in case something happens to me while I'm on the job. Is that insurance policy carried over after I leave the job, or do I have to set up an all new insurance plan when I leave the job?
Okay, great question. And the reason why is because a lot of people have insurance on the job, which is basically called group insurance, okay? And the group insurance is like you have, let's say, maybe you have 1,000 employees and the company offers a group insurance policy, and either the company will pay for the policy 100% themselves, or it could be a combination of the employee paying some and the employer paying some. And typically those policies will cover twice the person's salary. So let's say a person's making 50, the insurance policy, which is a term policy primarily, it'll cover a person for $100,000, which is 50, of course, twice, right? But when that person is no longer an employee of that company, okay, and depending on the age that they sever that relationship, they might say, okay, when you retire, you had a $50,000 policy, but now it's going to drop down to $10,000, and we're going to keep that $10,000 in policy in place for you for the rest of your life. Or they will give you the option to maintain the policy even after you're no longer employed. You can take over the policy yourself and pay any applicable premiums that might be necessary to keep the term policy in place. But that's going to depend on the company's guidelines regarding coverage, for an exiting employee. But that's a very important question to ask, and that's the reason why people become comfortable with their insurance on the job, and then all of a sudden they leave the company, and the company says, hey, we're not going to pay your coverage anymore. You're no longer an employee. So now the term insurance is gone, and they have no insurance, and they're 60 years old. You see? So it's very important to understand that relationship with that and understand what's going to happen if you leave, if you can maintain that coverage, or is it dropped at that point?
Right. I think that's what a lot of us, because that was pretty much a question that I had asked Joe about, but I think that's where we all get mixed up, whereas we think since we have insurance on the job that we're covered, but we don't get into the whole if I leave the job, what will happen?
Exactly.
So that's pretty helpful. Thank you so much.
Okay.
So Jerry, before you give your information, I would like to bring somebody else into the conversation.
Sure.
Her name is Jakisha Earth. She's an investment banker. She actually had chimed in on the initial post that we did for the Zoom, and she was talking about index universal life. So I would like to get her to chime in on that right now if she can. Keisha, are you there?
Peace. Yes, I'm here, Laura. Peace, everyone. Yes,
Peace, peace.
I did see that he's with the National Life Group. I'm with them as well. But I had
International.
transferred over to them about last year because I've been doing international investment private banking, but I am a derivative analyst and a quantitative easing research analyst, as well as a chief financial officer on Wall Street at Bellwether Capital Management LP. And I've been into financial advice, securities, and mutual funds, and I deal with direct trading on the platform for standby letters of credits, as well as bank guarantees and DTCs, MT103s, everything Swift, everything has to be Basel 3, Basel 3A compliance. So I'm happy that he did bring me to the call. And yes, I have trust. I have how many trusts? Managing trust, and then they have separate trust for my charitable trust. I have life insurance. I have an IUL. I have term life. When I started very young, when I was like 21, I started term life, and I do have an IUL as well. So this was great, core. But yes, everything like he mentioned, I do know the difference between consumer debt versus the insurance that he's talking about, because under the 7702 codes of the IRS, and I am a tax professional, is the reason why I go with the Index Universal Life, because it has the benefits, especially when the rule is 72 of the compounding interest. And that's another investment vehicle I use, especially on companies. Like I think someone asked about commercial insurance. Yeah, just like I use on companies, especially when they opened up to qualify opportunity zones. That's how I made, real money, because these people want an Index Universal Life for $1 million and better. They don't want anything less. So you make your money on the Index Universal Life, especially if it's definitely on companies as well. So that was what I said I would add on to. Please.
That's good to know.
Mm-hmm.
Very good to know.
Let me ask you this, Jakisha. You just spoke about the opportunity zones. Are there any opportunity zones set up in New York that we could be a part of or be abreast of?
There are opportunity zones in New York, but a lot of the opportunity zones in New York City are locked down. You already know what that is. That's all how mafias take over. De Blasio and them, they put in, and the thing with the opportunity zone, you have no tax for 10 years. So even you can also invest in a qualified opportunity zone. Now, the qualified opportunity zone goes along with the Index Universal Life. And the reason it goes along with the Index Universal Life is because of the compounding interest. So you speaking to someone that put in $1 million on an Index Universal Life to invest in a qualified opportunity zone. They don't have to pay anything back to that qualified opportunity zone of that $1 million. So when you think of compounding interest on an annual basis, you get $100,000 a year off of it, because that's your 10%. So that's why a lot of the investment people, they know how to take advantage of these special purpose vehicles. But you could probably look in New York, and you know what? You can always go on Zillow, Guard, when you want to look into the opportunity zones for New York, and you just put in a zip code.
Okay. That's good to know. Okay, so Jerry, we passing it back over to you. You can close out.
Okay. Well, again, what was her name again? The lady who just spoke?
Jakisha.
Yes, I want to say thank you for the input that you had, and hopefully maybe at some point we can have a further conversation, since you're doing similar things in terms of, estate planning and all that type of work. I commend you on your level of success, and certainly being able to share ideas is a very, very helpful thing. Again, I just think that just this whole conversation that we're talking about is the type of conversation that we need to have as a people to move in a new direction and be able to expand, because back in the day, they had something called each one, teach one. And I still think that that's a very, very good paradigm to try to move things forward. Now, Joe, do you see on the screen the quote that I have there? Do you see the quote?
Yes.
Okay. And this is something I read years ago by this doctor named Dr. Dennis Waitley. He wrote a book called The Psychology of Winning back in the 80s. And he said, it's not who you are that holds you back. It's who you think you're not. Okay. That always consumed me, because I realized that if you know who you really are and what you're really all about, nothing holds you back. You see? And so it's so many things that we see. The perception is their limitations, but reality is there are no limitations. And this whole thing we're doing right now with insurance and having these concepts and ideas, this is the next level conversation to create a new platform that allows generations to move forward. You see? So by you all taking the time out to open up this venue, you're bringing minds together that can shift the potential of the future. And that's what I'm about. I'm about now talking about generational stuff and about shifting the potential, because I've seen what happens when you're able to do that. Okay. Right. I was just down visiting a good friend of mine who's a real estate investor, and he had 2 beachfront properties in Corolla at 6.5 million apiece, right? As part of his real estate holdings. I remember when he first started out 20 some years ago, and all he had was his car. You understand what I'm saying? But he had a mindset of what he wanted, okay? And now he owns about 30 or 40 properties, commercial, residential, etc. And he can now do whatever he wants to do. He can help people. He's doing, different things. But the fact of the matter is, we all have that capacity to build and grow. And just like your company and what you're doing right now, don't let any obstacles stop you from where you want to go, because what you don't know, somebody else knows. And when they see you want to get it done and you show the commitment, you'll be surprised what opportunities will open themselves up for you. So again, I commend you on this situation, and I appreciate you allowing me to be a part of it. And I say thank you. Here goes the next slide. Okay, that's the information piece. Okay. Anybody wants to contact me, they can email me there. And if they want to send me something in the mail, that's my address, and certainly I'd be willing to have, a conversation. And I also do other seminars and estate planning workshops as well, anywhere that someone wants me to show up. Now that we have this ability with the Zoom, I certainly can reach anywhere from that standpoint as well. So again, I want to thank
Question, big bro. If somebody wanted to become an associate, what would the process be like to becoming an associate?
Well, again, every state has its own guidelines as far as becoming a licensed agent, okay? And depending on the company that we were talking about, et cetera, I would have to look at the guidelines, because New York is different than all the other states. Like the company I deal with, Midland, which is my primary carrier, they don't even do business in New York as far as, their normal active engagement, because there's so many restrictions in New York, right? Just recently, one of my other companies, Penn Mutual, which has been around, one of the oldest companies in the United States, they just said, we're not doing business in New York anymore. They completely shut it down. But I'm now connected to another company, though, Prudential, and Prudential is one of the largest insurance companies in the world. They have a portfolio still in New York, so I'll be working with them, as well as this company called Guardian Life, which is a company I started with in New York. I'm also contracted with them. So if somebody decides they want to get involved in the business and they're very, very serious about it, I'm still open to have that conversation.
Okay.
That conversation. Yeah.
So it was something that came across the wire earlier today.
Mm-hmm.
So in New York, they recently changed, and they're starting some police reform laws in New York. And what the governor is basically doing is he's saying that since people have been protesting about police reform, he's giving it back to the communities to figure out exactly what they want the police to do in the communities. Mm-hmm. So now if the persons who have been protesting haven't done their research, and they have exactly about 9 months to figure out exactly what they want to do with these police. Mm-hmm. So with that being said, it was a video that's been circulated by Dick Gregory, who recently passed away within the last few years, and he made the statement that the way that you have to work with these police in order to change the way that they've been policing is by having them all be insured. And when they're insured, if they were to do something on the job that jeopardize somebody's life or their livelihood, then they would have to pay out of their insurance. Do you think that that's something that would work? Is that outside of the scope of what you provide or would be able to know?
I would say, quite candidly, that's outside of the information that I have access to.
Okay.
I really have never even heard of that concept, and I'm not really aware of what that would be. Okay. I think though having community input is a really major step, in the right direction. And I think that having them kind of like restructure what's going on is very, very important. And I would say also that I think that officers that are in a highly, stressed zone should not be there for an extended long-term period of time. It should be like someone who's in the military who's on the front line, right? They put you on the front line for a period of time, but then they pull you out and recirculate you somewhere else, because if not, sometimes you can tend to be, just overstressed, by too much exposure. And I think that's one of the things that I would recommend as far as just having people rotate out of those situations on an ongoing basis versus staying in that kind of a situation continuously, So, but I think there's a lot of feedback that has to come, and probably somewhere in the middle, they're going to find some common ground.
Right. Makes sense.
That's great stuff. I'd like to say thank you so much for coming on and giving this vital information to our community.
Okay.
We're gonna keep pushing this, because I really think that it's important for us to build generational wealth. That's something that us as people of color or Black people in general do not have. And that's something that we're gonna have to build over this next century, so that we can have sustained growth and we can change this process that's been going on from century to century, where we've been seen as less than in this country. Right?
Exactly.
So this is the main factors why we've been doing these Zooms since COVID, because COVID has basically took the blinders off a lot of people when it comes to these disparities, as far as health, as far as schooling, as far as economics, as far as unemployment. It's just so many different disparities within the communities of color compared to these other groups. And this is one of them that is substantial. As you said, there's many people that have to put up GoFundMe pages just to bury their people. And burying somebody is very expensive. It's not something that you can just do off the fly or off the cuff. You really have to have a certain amount of money to bury somebody in a decent way. So that's very important.
Very important. Very important. So again, all of those things that you're talking about are all tied in. And, as we understand this whole process of this coronavirus and all this stuff, it just basically highlights the importance of being in good health to begin with. Because if you're not in good health to begin with, you already got one foot out the door because you're weak already. And so if the healthcare system is not functioning properly and people are already getting hit with something and they're already not in a healthy state, then that automatically pushes you out to the red zone. You see? So that's why addressing all of these different issues as a country, as a people, etc., is very, very important. And this is just, it's just basically shining the light on everything that's going on. And that's why the numbers are going to be in disparity, because of the fact that conditions already exist in disparity.
Right.
See? So that's where we are. So anyway, I'm going to shut it down now, but I want to say thank you all so much, and certainly it's been a pleasure to be able to share with you all, and hopefully some good information has been transferred. Okay.
Well, if you don't mind, with your permission, if we could have you again on the second Sunday of July, just to bring in more people. So I'm hoping that the people that actually was on can invite other people to get involved with this conversation, because we got to have a conversation before and ask questions and get the proper answers to whatever that we need information about before we just jump out there. Like you said earlier at the beginning, we don't have conversations like this. We should have had more people on this Zoom, especially when we talking about life insurance. So we're asking that everybody to please invite one other person, two other persons, and get them involved. Because like Jerry said, this is like a love letter, but this is a love letter through conversation on life insurance. So I would like for everybody to please do me a favor and just put your email in really quickly before everybody go their separate ways. Put your email in so that way I can save it and also send it over to Jerry. And as you see, he have his information up there as well. Please take a picture of it so that way you can ask him any questions or email him any questions you might come across between now and July on the second week of on a Sunday. If you don't mind, Jerry, if you're not too busy, we could still have the same time. We can set it up right away and just promote as much as we can, because this is really serious. Life insurance is real.
It's very real. And like I said, you know, whenever you're doing something like this, it's an ongoing process of building knowledge. You know, it doesn't happen overnight. I mean, I started in 1982 and I'm still scratching the surface. Okay.
Still look young.
You know what I mean? I'm scratching the surface of what's possible in terms of this business and helping people, you know. And as a result of seeing the bigger picture, that's why I know that it has to be a transformation of the mind first, because, you know, it really gets down to it with this whole thing too, is having the family intact in the first place. Because if you have the family intact, then you're not going to be able to protect what's not there. You see, you got to be there and put together a structure. And that's one of the things that's causing a lot of the problems that we're dealing with, is that the family structure is broken down. You see? And so as you rebuild that, then you're going to see other problems are going to take care of themselves. So we got to kind of like go grassroots and like, you know, redefine what that really means. And then when people start to see the benefits of that, they'll see that, okay, these people are having impactful situations because the family situation is tight to begin with, you see? And so we've been blessed to come from a family where the structure, where you're talking about a 62-year marriage, you know, that was in place, you know. So as a result of that, that structure, it created a good network of opportunities for all of us to build on that and continue it forward. And so now, you know, as you know, my mother's a minister, and she impacted a lot of people during her lifetime, and she's still impacting them now. But the bottom line is that she put good seed into good ground, you see? And now the impact of all that is allowing her children to impact more people in their ways, you see? So that's the idea, is to spread the positive hope that that situation can be dealt with. And in the meantime, we do what we can to educate, and not only educate, but demonstrate.
That's right.
Demonstrate what you're talking about.
Lead by example.
That's right. That's exactly right. So again, I want to thank you all for the opportunity, and I'll look at it for July, and we'll look at that scenario, and we'll kind of put something in place, because I believe in giving. I believe in that. So again, thank you all so much. Okay.
Thank you.
All right. Okay.
Peace to everybody.
All right, now, thank you. Okay. Thank you so much. Be well now.
Okay.
Peace.
Later.
Bye-bye.